AI is not only about chips, models, and software. AI also needs buildings. It needs land, power, cooling, network connections, and massive data centers that can handle the demand. That is where Digital Realty, ticker DLR, becomes interesting. Digital Realty is one of the major data center REITs in the market, and in 2026, investors are asking whether it could be another big winner in the AI infrastructure race. But this is not a simple story of AI is growing, so buy the stock. Data centers can be powerful assets, but they are also expensive to build, expensive to power, and heavily dependent on capital, execution, and timing. So the real question is this: is Digital Realty another major winner in the data center race? Or is the AI story already too easy for investors to overpay for? The AI race does not run only on algorithms. It runs on power, cooling, land, and data centers. Digital Realty is a data center REIT. The company provides digital infrastructure for customers that need data centers, colocation, interconnection, hyperscale capacity, and global reach. For beginners, the simple version is this: Digital Realty owns and operates the physical infrastructure that helps companies store, move, process, and connect data. It is not an AI software company. It is not a chip company. And it is not a cloud provider in the same way as the major cloud platforms. It is closer to the physical and digital real estate layer underneath cloud, AI, and enterprise technology. The company's platform includes more than 300 facilities, more than 55 metros, more than 30 countries, and operations across 6 continents. That scale matters, because AI and cloud demand are global, and large customers often need capacity across multiple markets. But scale alone is not enough. To understand Digital Realty as an investment, we need to understand how the company actually makes money. Digital Realty makes money by providing data center capacity and related infrastructure services. Customers lease capacity. Digital Realty provides space, power, cooling, connectivity, operational infrastructure. The customer is not just renting an empty building. The customer is renting access to power, cooling, connectivity, security, scale, and reliability. That is why data centers are different from ordinary real estate. A warehouse stores goods. A shopping center hosts stores. A data center supports digital operations that may be critical to a company's entire technology stack. This is why the asset can become sticky. Once a customer puts important infrastructure into a data center, moving it can be expensive, risky, and complicated. So Digital Realty's business model can be attractive, but it depends on demand, pricing, renewals, development, and capital discipline. And in 2026, the biggest demand story is AI and cloud. AI and cloud workloads need data center infrastructure. They need compute, high-density power, cooling, low latency, data movement, connectivity, and hyperscale deployments. When a company trains models, runs AI applications, moves enterprise data, or expands cloud usage, that demand does not happen in the air. It happens inside physical infrastructure. That is why data center REITs became so important in the AI infrastructure conversation. But investors need to separate demand from returns. AI can create demand, cloud can create demand, hyperscale customers can create demand, but data center REITs still need profitable capacity. If a company builds too expensively, faces power constraints, takes too long to deliver projects, or funds growth poorly, strong demand may not translate into strong shareholder returns. So the opportunity is real, but the math still matters. And to understand DLR's position, it helps to compare it with another major data center REIT, Equinix. Digital Realty and Equinix are both major data center REITs, but they are not exactly the same story. Equinix is often viewed as the interconnection platform story. It focuses heavily on enterprise ecosystems, cloud connectivity, and customers connecting with networks, partners, and platforms inside its facilities. Digital Realty is often viewed more as the scale and capacity story. DLR has major exposure to hyperscale demand, large deployments, global data center capacity, and the physical infrastructure needed to serve big customers. That does not mean Equinix has no scale, and it does not mean Digital Realty has no interconnection, but the emphasis can be different. EQIX is often the platform story. DLR is often the scale and capacity story. For investors, that difference matters because the risks and opportunities are not identical. Digital Realty may benefit strongly from AI and hyperscale demand, but it also needs to deliver capacity profitably. So now let's look at the numbers. In the first quarter of 2026, Digital Realty reported revenue of $1.6 billion. Adjusted EBITDA was $920 million. FFO was $700 million. FFO per share was $1.99, and Core FFO per share was $2.04. Core FFO per share was up from $1.77 in the first quarter of 2025. These numbers matter because the AI story has to become financial performance. For a REIT, hype is not enough. The story needs to become rent, EBITDA, FFO, and eventually cash flow that supports the business and the dividend. So when investors analyze Digital Realty, they should not only ask whether AI demand is growing, they should ask whether that demand is improving the actual economics of the company. Revenue growth matters. EBITDA matters. Core FFO matters. But with data centers, there is another key signal: bookings and backlog. Bookings and backlog help investors separate real demand from pure narrative. In the first quarter of 2026, Digital Realty reported expected total bookings of $707 million in annualized GAAP base rent at 100% share. Digital Reality's share was $423 million. The company also reported total backlog of $1.8 billion at 100% share. Digital Reality's share of that backlog was $1.0 billion. Those numbers are important because they suggest real customer demand. But backlog is not the same as cash flow today. There is a timing issue. The company reported a weighted average lag of 19 months for new leases, so demand may be signed, but it still needs to be delivered. Backlog shows demand, but delivery turns demand into cash flow. That is why guidance becomes the next important part of the story. Digital Realty raised its 2026 guidance. The company expects total revenue between $6.65 billion and $6.75 billion, adjusted EBITDA between $3.65 billion and $3.75 billion, and Core FFO per share between $8 and $8.10. That is important because guidance gives investors a map of what management currently expects. It helps frame the year. It helps investors compare the story with the numbers. But guidance is not a guarantee. Demand can change, construction timelines can change, power availability can change, capital markets can change, and customer delivery schedules can change. So the guidance supports the data center thesis, but it does not remove execution risk. Digital Realty still has to build, deliver, and fund the capacity customers are demanding. And that brings us to expansion. For Digital Realty, capacity is the product. If customers want more AI and cloud infrastructure, DLR needs the land, power, development pipeline, and execution ability to deliver that capacity. That is why expansion matters so much. Digital Realty has been adding to its future capacity, including a major land purchase in Atlanta of 873 acres, designed to support more than 1 gigawatt of future IT capacity. That kind of scale shows how large the data center opportunity can be. But it also shows why this business is so capital intensive. Capacity is the product, but capacity is expensive to build. Land costs money, power access takes planning, development takes time, and projects need to earn attractive returns after all the capital is deployed. So expansion can be a competitive advantage, but it is also one of the biggest risks. Let's talk about that risk directly. The data center race is not won by demand alone. It is won by building profitably. That is the first major risk for Digital Realty. Data centers require high capex. They need power, cooling, construction, equipment, permits, land, and strong execution. If power is not available, growth can be delayed. If construction costs rise, project returns can be pressured. If delivery takes longer than expected, backlog may take longer to become revenue. And if development yields are not strong enough, growth may not create as much value as investors expect. Digital Realty's guidance points to major capital spending, with capex net of partner contributions expected in the billions. The company also targets stabilized yields above 10%. That sounds attractive, but the company still has to execute. AI demand may be strong, but profitable execution is what turns demand into shareholder value. And that leads to the second major risk: funding the growth. Digital Realty's growth depends on capital. That means debt, equity, joint ventures, asset sales, retained cash flow, and access to financial markets can all matter. At the end of the first quarter of 2026, Digital Realty had total debt of $18.0 billion. Net debt to adjusted EBITDA was 4.7 times. Fixed charge coverage was 4.9 times. Those numbers help investors understand the balance sheet. This does not mean DLR is in trouble, but it does mean investors need to watch funding carefully. Data center growth is expensive. If interest rates are high, refinancing can cost more. If equity valuation is weak, issuing shares can be less attractive. If capex needs keep rising, capital discipline becomes more important. Growth is attractive only when the capital structure can support it. And this is exactly why we analyze the full picture, not just the AI headline. This is the kind of no-hype REIT analysis we focus on at Boring Money Wins. Not buying a stock only because it is connected to AI. Not ignoring Core FFO, backlog, capex, power, debt, interest rates, and valuation. And not pretending that every data center REIT will automatically be a winner. If this kind of investing breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want clear analysis instead of noise. Now that we understand the opportunity and the main risks, let's make this practical. Who may actually like Digital Realty, and who should be careful before buying DLR? Digital Realty may appeal to investors who want exposure to data centers, AI infrastructure, cloud growth, and hyperscale demand. It may also appeal to investors who understand growth-oriented REITs and are willing to analyze development, funding, and execution. But some investors should be careful. If someone is buying only because of AI hype, that is risky. If someone ignores debt, that is risky. If someone does not understand backlog timing, that is risky. And if someone expects bond-like safety, DLR may be the wrong tool. Essential infrastructure is not the same as risk-free income. Data centers can be critical to the digital economy, but the stock can still fall. The company can still face delays, and valuation can still become too expensive. So, Digital Realty may fit investors who want data center exposure, but only if they understand what they are actually buying. And that brings us to valuation. Price still matters. Digital Realty may be a strong data center REIT. It may benefit from AI, cloud, and hyperscale demand. It may have a large backlog and a major development pipeline, but investors can still overpay. That is why valuation matters. Investors should look at price to Core FFO, FFO growth, debt, capex, development yields, dividend yield, and competition with other data center players like Equinix. A data center winner can still be a bad investment if investors overpay. That is especially true when the market is excited about AI. The louder the story gets, the more discipline investors need. So the right question is not only whether Digital Realty is a high-quality company, the right question is whether future cash flow justifies today's price. Now we can bring everything together. So is Digital Realty another major winner in the data center race? It could be. DLR is one of the major names in data center real estate. AI, cloud, and hyperscale demand all support the long-term thesis. The company has meaningful bookings, a large backlog, and guidance that support the idea of continued growth. But investors should not ignore the hard parts. Capex matters, power matters, debt matters, delivery timing matters, valuation matters, and execution matters. Digital Realty may be another major winner in the data center race, but investors still need to ask whether future cash flow justifies today's price. The best AI infrastructure investment is not the one with the loudest story. It is the one where cash flow survives. That is the boring answer, and boring money usually wins because boring money usually survives.